welcome you all. Call the investment committee meeting to order. And Kayla, I'll ask you to take a roll call, please.
Trustee Martin,
Here.
Trustee Riley,
Here.
and Trustee Moore.
Here.
Great, thank you. I just want to remind all participants to please leave your mics on mute while you're not speaking. And want to welcome everybody here. I believe, Kayla, and you can correct me if I'm wrong, but I think right now we have a quorum. But Trish, if you step away, totally okay. I want you to have a warm house. We won't have a quorum, but we don't have any action items. So this is going to be a lot of informational, a lot of information we get from our consultants today. So without further ado, I'd like to introduce our first item, tab 1, investment committee work plan. And Tracy, if you don't mind, I'm going to ask you just to give an overview on work plans and why we have them, and you know, how often we review, we put a work plan together for the benefit of John. I think all of us here have heard this, but this would be a first for John. So if you wouldn't mind, Tracy.
Happy to. And good morning, everyone. Annually, we look at the work plans, all of the committees, this time of year, and then they go to the board in November. And it's not an action item, but it's just a refresh and to remind us what it is that we do and to make any modifications. No modifications were really needed to this plan. Typically, it's pretty routine. Every meeting we hear about the capital markets, whether that is from one of our 2 consultants, and we do have, for those who aren't familiar, we have a defined contribution plan, and the consultants that assist us with that are CapTrust, and Mike Pratico is here with us today. And then the other area is advised by NEPC, and that is the university's portfolio. 3 of those, the managed investment pool, the operating fund, and the closed defined benefit pension plan. So every meeting will have some capital markets update from one or both of those consultants, as well as performance in our university portfolios and updates on the managers in both portfolios. And then throughout the course of the year, the agenda items will vary. Typically in the winter for the university's portfolios, we'll have updates on opportunities in the market and asset allocation changes. Sometime during the year, we also will have investment policy updates and changes as appropriate. Any meeting could include a manager update and interview if we're looking at swapping out managers or a result of a search that NEPC has conducted. We also look annually at the future endowment distribution rate related to the university's endowment funds for scholarship and other purposes. So that's approved by the investment committee following discussion with the chief business officers and a recommendation there. Fossil fuel divestment, we have a strategy and a mandate for divesting of fossil fuels in the university's portfolios over a period of time. We spent a good amount of time over the last several years looking at that, and so we periodically get an update on our progress there. And fiduciary training, so that you're familiar with your requirements. CapTrust periodically brings some discussion on that item, as well as an electronic tool that they use for us to watch offline and have discussion after. So I think that is, in a nutshell, the majority of what this committee does. Happy to take any questions.
Thank you, Tracy.
You're welcome.
And Mike, it looks like Mike just joined. You there, Mike?
Yep, I'm here, Kelly. Sorry, I was just on mute and turned off my camera for that first section, but good morning, everyone.
Good morning. So Mike is gonna do a quarterly review of the defined contribution plan, and go right ahead, Mike.
Okay, thanks a lot, Kelly. And again, good morning, everyone. It's talking to Kelly and Tracy just a couple days ago in advance of this meeting, talking what a great time of year it is for us all to live in Maine. It's absolutely beautiful in the fall, and Thrilled to be here today. It's actually should be a fairly straightforward quarterly review for the most part. It's all really good news from a market perspective, from a fund performance perspective. There's even some good news from a regulatory perspective as well. I wanted to start and just see, could someone just give me maybe a thumbs up that you can see the cover page of our presentation? You got that? Okay, thank you. So I'm going to jump ahead, and typically we don't spend a lot of time on industry updates, but with the fairly significant legislation called the Secure Act and the Secure Act 2.0 that was passed earlier this year, we try to keep this group up to speed. We certainly get into a lot more detail on these things when we talk about the internal team at the UMaine system. But one of the key provisions that was written as mandatory for 1/1/24 was this concept of having catch-up contributions for people making over $145,000 per year move to a Roth basis or a post-tax basis. And this is something that was really causing a lot of headaches, if you will, for plan administrators, for payroll providers, even for record keepers as well, because 1/1/24 is creeping right up on us. This is something that a number of industry groups kind of sent a letter in to ask for a delay to this specific piece of legislation. And fortunately, we got that. So there's now a 2-year window that we have for the implementation of this provision. And again, I think that's really ultimately a good thing for a number of different reasons, not the least of which is just, the amount of work and scrambling it was taking to try to get this implemented. I frankly had clients that were going to have to suspend catch-up contributions because they just simply weren't prepared to implement this provision. So again, I just wanted to bring this group up to speed on the fact that we now have kind of a 2-year period before we have to implement that mandatory Roth contribution for people doing catch-up, making over $145,000 a year. Just saying that, you can see how confusing it would be for people. So that's certainly a good thing. And also the other thing is that it does give the UMaine system and other organizations an opportunity to really take a deeper look at some of the optional provisions. The Secure Act had about 90 different provisions, many of which were optional. And so the nice thing now that we're not kind of scrambling to get this implemented, it does give the system an opportunity to take a step back and really take a look at some of those optional provisions to see if they could be meaningful additions to the retirement plan. So again, I think really good news there, because frankly, as you all know, 1/1/24 is really coming right up on us, and that takes a lot of pressure off the folks at the university system. There's a couple other pages. I won't go into detail, for this particular group on some optional provisions, including qualified student repayment programs. But this is something, that we've talked about with Kelly and Tracy and others inside the university system. And, certainly I know that those conversations continue with TIAA, the plan record keeper, as well. So shifting to markets again, and keeping with the theme of it's all good news, it certainly has been good news through the first 2 quarters of the year. As you know, we're kind of pushing towards the end of the 3rd quarter now, and I certainly have updates that a little bit more timely. But when you look at this through June 30th, you can see U.S. large cap stocks up about 17% year to date. That number actually went up for a period of time to north of 20%. And then it's really come back down year to date through yesterday. Refers to the Standard & Poor's 500 index, has closed up about 16% through yesterday. So again, off the highs for the year, but certainly still a very good year. And that's now the 3rd quarter in a row where we've seen positive performance in the equity markets, going all the way back to the 4th quarter of 2022. So, certainly encouraging results there, and that's reflected in the growth of plan assets as well. International equities, you can see a little bit more muted, up 12%, and that number has come down as well. So international equities, and that's the EFI, the EAFE benchmark, up about 8.5% per year through yesterday. So domestic equities continue to outperform international equities. That's meaningful for the UMaine system plan, because the qualified default, or the default investment fund for the university system program, meaning that if someone doesn't make an active election and goes into the plan, they're defaulted into a Vanguard target date fund. Vanguard's thesis for a number of years now has been overweight international equities to domestic equities. They just feel like there's more opportunities there. And frankly, that thesis just hasn't played out, as they expected. They continue to believe that that's the right choice. But again, from a performance perspective, that's been a slight detractor. And as you'll see, the Vanguard Target Date Series, continues to do really well. But that would be, one detractor to performance is that overweight international equities specifically within that equity sleeve. And then you can see bonds. This is the aggregate bond index, up about 2.1% through the close of the second quarter. And that number has really come down pretty significantly. The ag is basically flat on a year-to-date basis. It's up about 5 basis points. So it continues to be a really challenging environment for bond managers, for bond investors. We continue to be in this really unique inverted yield curve environment. The Fed, I think, as everyone knows, held on the rate increases yesterday, but indicated that there will be another one coming up perhaps later this year. So again, it continues to be a real challenging environment for bond investors. One of the things that's great about the UMAIN, there's a lot of great things, frankly, about the UMAIN system program, but having that TIA traditional, which right now pays a yield of 6%, it's a uniquely strong investment option that UMAIN system participants have access to. In such a challenging fixed income environment, that certainly is a very attractive fund. And then finally, you can see here commodities. This is really driven largely by energy, but you can see commodities down about 8%. And so that, the theme, if you will, of this market overview is really going to be rotation. So we have seen this market rotation go from a growth-oriented market in 2019, 2020, most of 2021, to a value-oriented market in 2022, and then all of a sudden this rapid rotation back to growth. Similarly, energy, which in 2022 is really essentially the only place to make money in the market, all of a sudden we're starting to see energy prices and commodities overall come down as well. So again, I want to emphasize it's certainly been a really good quarter, a really good year as well in the markets, and that's reflected, in the assets in the UMAIN system plan. But I certainly feel like we continue to be in volatile economic times. There's a lot of just kind of mixed economic messages out there, not the least of which is up here in the upper right-hand corner, which is this continued inverted yield curve environment that we're in. It's really, again, a lot longer than we expected the yield curve to invert. When we talked last quarter about the different market scenarios our firm has laid out, everything from the most optimistic, which is that we're going to get that quote unquote soft landing that the Fed wanted and avoid a recession, all the way over to the most pessimistic being a stagflation crisis. Our feeling was that we were likely headed for at least a mild and hopefully short recession, in part because we've never not gone into a recession when the yield curve has inverted like it has. It's just going all the way back to the 70s. It's never happened. On the other hand, we've never gone into a recession when unemployment rates are as low as they are. There's still about 1.5 jobs available for every one unemployed person. So again, there's that mixed economic message. We, feel it's a much more likely scenario now that we will avoid a macro level recession. It's not to say that we're already out of in the clear and on to stronger economic times. I still think, or I should say, we continue to have a fairly cautious outlook on the markets. But that caution is certainly continues to lean more towards cautious optimism at this point. And most market prognosticators do seem to think that it's a likely scenario that we do avoid a recession at this point, and that's certainly a good thing. The other thing about this inverted yield curve, and particularly how it impacts the UMAIN system plan, is that right now, with bond funds struggling, most stable value funds right now, are yielding in the 2.5, in some cases 3% range. I go back to that TIA traditional, where having access to that 6% guaranteed account really is another nice feature of that the UMaine plan. And then finally, from a market perspective, you can see down in the bottom middle column, you can see this really indicates that rotation back to growth. So if we were looking at this chart almost during any quarter of 2022, you would have seen that value, large, mid, and small was just a better place to be. And all of a sudden markets have not just rotated back to growth, but really rotated back to growth being driven by big tech. So if you think back to 2019 and 2020, there were about 10 names that were really driving the market. It was Facebook, Amazon, Alphabet. Those 10 names, those big tech names were really the place to be in the market. All of a sudden last year, tech was out of favor. This year, it's rotated right back to, if you look at the S&P 500 returns, it's largely being driven by those same 10 names. Plus, you can throw NVIDIA in there as well, which is a big tech company that really supports AI development. So, again, these types of market rotations, when we get to the funds, you'll see do tend to have an impact on the short-term performance of funds. A fund in your lineup like Harbor Capital Appreciation, for example, which was the darling of your fund lineup in 2019 and 2020, all of a sudden 2022, we were looking at performance down in the 80th percentile. We continued to feel fine about that fund, continued to have a hold recommendation on that fund. And now here we are, through the 3 quarters of 2023, and that fund is up, 35% and in the top decile. So a lot of times, with the underperformance of funds, the theme is patience. It's something that we really preach. We think if we continue to believe you have good fund managers and a good process, that you should stick with funds, and that continues to be the case, even though we're looking at some short-term underperformance across a couple of your funds. And then finally, from a market perspective, I just wanted to stop on this slide and show you what I mean about the sector performance of the S&P. And you can see this is through the first 2 quarters of the year, technology up 40%, which is really just a remarkable number. So any questions from markets? I know you're going to hear a lot about markets from NEPC as well, but I wanted to really focus on markets and particularly talk about how the markets impact your funds within the University of Maine system plan as well. There's a number of other slides that kind of detail that market commentary, which I won't go into in this particular meeting, but I just want to pause and see if there's any kind of market related questions at this point before we talk specifically about the system plan. Okay, thanks. That was really just my excuse to get a drink of water to see if, but page 19, is just a snapshot of the fund lineup. And again, we continue to think that this is just a really, well-structured fund lineup. You have all the critical assets classes covered, both best-in-class active funds. You have a full suite of index funds. In addition to that, I think you have arguably the best possible default option in the target date suite, which is those Vanguard target date funds, which I just continue to be a really good choice. I'm a huge fan of target date investments. I think, you really check 95% of the investment box. You have a diversified portfolio, low cost, professional management, and an automatic de-risking. So again, really good choice there. The other step, and I really look at the plan as just a series of evolutions over the last 10 years. And the other thing that recently was implemented was the fee leveling approach to again, as the name implies, level out the fees and move to a flat fee payment methodology as well. So when you look at the fund lineup you have in place, you can see they're all institutional share class, essentially the lowest share class funds that are available. And, going back to the Secure Act, the piece of that legislation that we continue to hope moves forward is 403(b) plans like yours being eligible for collective investment trust vehicles, because at CapTrust, we have access to a number of CITs because of we have about $850 billion in assets under advisement. We use that market muscle, if you will, to negotiate low cost CITs for our clients. And if and when that piece piece of legislation is officially passed and there continues to be some regulatory leaps that have to be made in order for that to happen, we're certainly in a really good position to even bring the plan costs down lower. So again, we think the plan is in a really good place right now, and hopefully there'll be potential for even further improvement down the road. I won't go through each plan, contract by contract, but this is a really good summary page, and you can see that the plan is about $1.8 billion in total plan assets. And then this chart down here refers to some of the frozen accounts. So the UMaine system used to offer a number of different choices, Voya, Fidelity, and Corebridge, and we try to get a quarterly report from those providers so that you can see what continues to be out there in those frozen accounts. But again, $1.8 billion in total plan assets, and again, some really good plan growth. As I jump ahead a couple pages, and I apologize, it looks like there's a little bit of a delay here with the screen coming clear on my end anyway. But if we just look at the biggest of the plans, for example, you can see we started the year at about $1.3 billion and closed out the second quarter over $1.4 billion. So, again, we continue to see really, really good growth. And that's the third quarter in a row where we've seen asset growth in the system plan. All right, so I'm going to jump ahead, and again, bear with me. For some reason, I'm getting this delay, so it's taking me a little bit longer than usual to get to the correct slides here. There we go. Okay, so from a scorecard perspective, I think almost everyone on this call at this point is very familiar with our scorecard. But if anyone ever wants to spend additional time getting into the details of our scorecard and our scoring methodology, certainly, I'm always available. Barry Schmidt, my partner, is always available as well. But just in summary, quick recap: it's a 100-point scale. Anything above 80 is considered in good standing. 70 to 79 is marked for review, and below 70 is marked consider for termination. We always like to emphasize that this scorecard is just one part of the evaluation process. It's not meant to force action. And what I mean by that is that if a fund slips into that consider for termination category, really the operative word there is consider. It's not categorized as terminate fund. It's categorized as consider for termination. It's really meant to promote dialogue. It's not unusual to have a fund that's marked considered for termination that we have a hold recommendation on. There's also been instances, though rare over the years, where we've recommended terminating a fund that's in good standing. Typically, that's the result of some significant qualitative event, like a lead fund manager departure, something to that extent. But again, we think that it's a really good scoring methodology, but I do want to emphasize it's just one part of the overall review process. When you look at the scorecard, really everything remains in good standing with one exception. And frankly, even that one exception, the American Funds Euro-Pacific Growth, is not a fund that we have any concerns about at all. Euro-Pacific Growth continues to be our top conviction choice in the foreign space. Where we are looking at these kind of yellow due diligence notes, if you will, the theme is really stylistic headwinds. It's not an issue with management. It's not an issue with bad decisions. It's really an issue with kind of the stylistic headwinds that oftentimes come with major market rotations. And again, I go back to that process where markets went from growth to value back to growth again. That typically leads to some underperformance with individual funds. JP Morgan Equity Income, you can see the 3-year performance of that fund is just slightly below the 50th percentile. That's what this due diligence mark refers to here. But overall, that fund is scoring 94. That indicates 5-year performance that's in the top quartile, so beating over 75% of its peers for a 5-year period of time. It's actually coming off a really strong year last year as well, where it was in the top 20th percentile. But this year, as markets have rotated back to growth, we're seeing some underperformance. So it's currently operating through yesterday down in the 88th percentile. And that's what's really dragging that 3-year number down. So again, our scoring methodology really emphasizes 5-year performance. We think those 3- and 5-year time periods are much more relevant. We certainly look at the short-term performance numbers But generally speaking, not something that we're overly concerned with, as is the case here. Going down, I already talked a little bit about Harbor Capital Appreciation. Again, still in good standing, scoring an 86. And that's a fund that, really just did incredibly well. One of those years back during the big growth years, the fund was up over 50% for the year. It operated almost exclusively in the top quartile for 3 straight years. And then we saw that pullback last year, which is what we really expected to see with a fund that has a fairly high concentration in those big tech names. But again, this is one of those funds where, the market rotation, while it hurt some funds like the JP Morgan Equity Income, it really significantly benefited this fund. And again, with performance up in the 35% range year to date through yesterday, and again, operating in the top decile. So certainly no issues there. And again, the fund is in good standing as well. And then finally, MFS Growth, you can see 3-year performance there is also below the 50th percentile, but overall that fund is scoring 88 as well. The 5-year performance of that fund is top third. So these individual due diligence notes are certainly important. It indicates below 50th percentile performance for a 3-year period, but in all instances, the performance is really just slightly below the 50th percentile. And I think largely explained by, the stylistic headwinds that go along with these market rotations. And then finally, Euro-Pacific Growth, again, your core foreign option here. You have both a foreign growth and a foreign value. Euro-Pacific Growth is actually a foreign large blend. So it's a blend of growth and value. That's what blend refers to. And this is a growth leaning blend fund. So all blend funds tend to lean growth or lean value. This is more of a growth leaning blend fund. And so that growth lean, international markets, actually value is doing better right now. And so that growth lean has caused a little bit of underperformance. But really, when you look at that score of 77, that is being largely driven by essentially one bad year. 2021, the fund was down in the 80th percentile. A lot of that was due to an overweight position in emerging markets. So if you look at the peer group of this fund, it has very, very little, or in some cases, no emerging markets exposure, where this fund tends to have a fairly significant exposure to emerging markets. And again, that can be additive or not, depending on how emerging markets are doing. And so that caused a little bit of the underperformance as well. Year to date, Euro-Pacific Growth is up about 7.5%. It's in the top 40th percentile. The 10-year number, the 5 and 10-year numbers of that fund remain really strong. And again, we don't have any concerns. I think that fund, based on the near-term performance, will probably be back in good standing as soon as next quarter as well. So one fund marked for review on this page, but really not a fund that we have any concerns about. It continues to be our top conviction choice. If we're starting from scratch, with kind of a blank slate, building a fund lineup, we're still using Euro-Pacific Growth as our core foreign blend fund. And then finally, as we move over to the next page, you can see MFS. This is your value leaning international fund. And that fund is actually having really an exceptional year, up over 10% and just outside of the top decile. But that 3-year performance is slightly below the 50th percentile. And then finally, Victory Sycamore, coming off, really 4 outstanding years in a row where the fund operated almost exclusively in the top quartile. But again, some short-term lagging performance based on that market rotation back to growth. Excuse me, but overall scoring a 92. So your core lineup of actively managed funds continues to be in really good shape. We have a few short-term underperformance issues, which we're not concerned about at all. And we certainly don't have any change recommendations, or frankly, looking forward, can't imagine, barring some type of qualitative event, that there will be change recommendations, in the foreseeable future. So I'm going to pause there and see if there are any questions before I shift to the target date funds and the index funds. Okay, so when we shift over to the target date funds, you can see the Vanguard target date series continues to score really well. with a score of 90. Having so far a good year this year, the more conservative of the series, like the 2030 fund, is up in the top 20% peer relative. The more aggressive vintage, like the 2060 fund, is in the top 40th percentile. Again, little bit of detracting performance from the overweight international, but not something that we're concerned about at all. That's consistent with a lot of target date managers. The two largest target date fund managers are Fidelity and Vanguard, and both actually have that overweight international position, feeling like there's more short-term opportunities in the international markets. So again, I'll just summarize by saying I continue to think the Vanguard Target Date series is an exceptional choice as both a default investment and frankly as a choice, as an active choice as well. We show the Vanguard Money Market Fund. That's actually not an active investment option. That's really just there for loans, for short-term, a place to park short-term money in the case of loans. And in the capital preservation space, I should say, it's really that TIA traditional. And you have the retirement choice, which is a more liquid version of the TIA traditional, but still pays 6% right now. So the way that works is TIA basically kind of buckets the money based on how long you've had your money sitting in that account. But the current yield on the TIA traditional is 6%. And again, I think, really an exceptional choice. It's not as liquid as a money market. You're paid out over basically a 9-year period of time. But for a lot of people, that's actually part of the appeal of that fund, is that they look at it as kind of a structured income when they hit retirement. So certainly no issues with that at all. We continue to think that that's a good choice, and really is having this period of time, I think, is about as good as I've ever seen it for the TIA traditional account. And then finally, your full suite of index funds with Vanguard. You can see you're in the institutional share class of all of those choices, and those are all in good standing, as is the CREF stock and TIA traditional. CREF stock and TIA traditional, we actually break out separately because they're what we call distinct asset classes. They don't fall into a kind of a simple category, if you will. And so there we just provide an overall score of in good standing, marked for review, or considered for termination, and both of those are in good standing as well. So your overall plan score remains really strong with a score of 94. You've had what I would describe as a remarkably stable fund lineup. We have not had to make a lot of changes to your fund lineup over the last several years. You can see the last one we made was in the small cap value space. But overall, a really strong plan score. Again, not that score is just one part of what we look at when we look at the strength of your plan. But I think it's a meaningful part, and it shows that your plan is in really good shape. And I think more importantly, continues to be really positioned well on a go forward basis. And so I'm gonna pause there and see if you'd like me to get into more details on any of the specific funds that I talked about, or frankly, market or even Secure Act, if you'd like me to. No questions? Well, I told you it was going to be a straightforward quarterly review this quarter, and that's certainly proven out. I may have set a record here in 34 minutes. So. Yes, Trustee Riley.
I don't want you to get away without some questions. Can I go way back to the beginning? I was intrigued by the options and the possibility of a student repayment, loan repayment program. Could you just give me a capsule? I'm sure the team's looking at it, and I don't want to take a lot of time, but what is that?
Yeah, no, that's a great question, and thank you for that. I do appreciate questions. I'm trying to go back to that page, but while I'm trying to get there, I'll summarize it by saying that, first of all, there's a number of different student loan repayment programs out there. I know TIA has some. There's a number of ones off TIA platform. But what this specific program refers to, and I apologize, for some reason, I'm really getting these huge delays. But what this new program refers to is the opportunity for people who have student loans that are deemed as so burdensome that they essentially can't afford to save in a matching program. What this program would allow the university to do is essentially consider the student loan payments as qualification for the match. And so what a person would have to do is prove that they're making those student loans. And let's say that, you know, those student loans represent 3% of their income. They could actually get the matching contributions without actually having to contribute that 3% to the retirement plan. And that's what that qualified student loan payment program refers to. It's, you know, it's certainly administratively, you know, would take some work because, you know, you have to, you know, document that a person has the student loans, document what percentage of their income. But again, I think, you know, I hate to see people where the matching contributions, I hate to see people not taking advantage of that. And if student loans are the reason for that, this is kind of a workaround, hopefully short term, until people can afford to take advantage of the matching.
That's, as a former employer of a lot of younger people who wouldn't take the pension plan because of that, I'd love to know more about it when the team has a chance to look at it.
You know, when I'm doing employee meetings, I still love to do employee meetings. Actually, I'm doing one coming up on Friday for the UMaine system. And I always say that the single best financial advice I've ever gotten in my life, I mean, not even close, is the first day I joined the real workforce. I started at Unum. I was making no money. I mean, like literally no money at all when I got out of college. And someone pulled me aside on the first day and said, no matter what it takes, you need to save 5% of your pay in the 401k. We had a match up to 5%. And honestly, I feel like I was kind of bullied into it, but it ended up being the best possible advice I could have gotten. You know, now, you know, 30 plus years later, as I look at my retirement account, it's largely because I started young, not because I'm saving a ton now. And so, yeah, that's a really long story to agree with you. That I think
bullying doesn't work anymore with these high costs. So this is
yeah. No, I say bully, but it was just simply great advice, and I'm glad I took advantage of it. I still remember the guy's name because it was such good advice. So.
Yeah, it is amazing how you can't make up for time in many things in life, and in investing, it's a huge component. Huge.
Yeah, and now, you know, with the Roth feature for young people as well, you know, to be able to get matching contributions and then potentially have that money accumulate tax-free over a 40-year period of time. I mean, it really is, it's a great way to save for sure.
Mike, you mentioned something about, I know we had a conversation with you on that on Monday, Tracy, you and I, but share with the group the educational sessions that you're hosting or that are being hosted on campuses and how effective they seem, like the population of the groups that you're talking to. And
yeah, thanks, of course. And this week is a big education week for the UMaine system. Starting yesterday, I think they're all at lunchtime. I could be wrong about that, but mine certainly is at lunchtime on Friday. And so mine specifically is basically titled Understanding Your Retirement Plan, or Understanding Your 403B Plan, I should say. And basically, it's a high-level overview of the plan. We're going to talk a little bit about the transition to the flat fee pricing, as well as the fee leveling arrangement. We're going to talk about things like the advantages to saving in the plan, the Roth feature, the strength of the fund lineup. And it's really meant to be an education. You know, TIA does a good job with individual meetings, but this is really meant to be more of a broad-based education for people to get them interested, keep them interested, and also just so that they continue to understand their plan. But the signups have been really exceptional. I mean, for my session alone on Friday, we have over 300 people now signed up. And as I was looking at the signups last week, I know it was, I think, over 250 people for each session every day of the week. And, you know, I was telling this to one of my colleagues the other day, and, you know, they said that a lot of organizations talk about educating their employees and caring about their employees, but, you know, unfortunately, not a lot take that next step and actually do it. And so it's just really refreshing to see that the University of Maine system is really committed to that process and that continuing education. And this is something that we did last year as well and was really well received. And I think we'll probably continue in future years as well. So I think, you know, whoever organized that internally just kudos to them because it's a really good program and clearly something that employees want because of the sign-up numbers. So.
Yeah, if I could just add a couple of things to that, and we've had great success in the enrollment. It's the HR benefits team, and they're offering a different program every day this week during lunchtime. And those recordings are also available on the demand. I think you have to sign up, or maybe there's a web link, but if people sign up, then they could go in, or I just went in now and I can see that they're available on demand. So people could even watch them again, or people who didn't have the opportunity. So they are great.
No question, Mike, but I did want to tell you how much I love the phrase stylistic headwinds. I'm going to try to work that into my next budget presentation.
Yeah, we can find a cool way to describe underperformance, really. So, but thanks.
No, this is
okay. Any other questions for me?
Just a comment, Mike. I just these educational sessions, they're amazing because just like the story you just shared about somebody quote unquote bullied you into savings, a lot of people don't have they don't have the understanding of investments, and it's impactful for the rest of a person's life in their family, retirement. If you can catch them, you know, at a certain point and educate them not to be taking withdrawals out of retirement plans early if they you know don't have to, and all kinds of things that are pitfalls when saving for retirement. I really like that. You know, an educated investor is a good investor, and like I said, it's life changing. So
yeah, and also why I think features like auto enrollment and auto escalation and defaulting into, you know, a good quality target date series. You know, again, I look at, you know, some of the legislation that has passed over the last really 15 or 20 years to improve retirement outcomes. And it certainly has been very meaningful. I would argue auto enrollment may be right at the top of that list as well. So, well, thank you, everyone. It was great to, I'm sorry, Trustee Martin, is there anything else before I sign off?
no, just thank you for your in-depth presentation. Always enjoyed, and have a nice fall. I guess we meet again in December. So hope to see you around.
It's great to see everyone.
Thank you.
Bye-bye.
Take
Bye.
care.
Thanks.
And moving on to tab 3. Kelly, are you? Yeah, Kelly's with us from NEPC, and she's going to give us an overview of, hold on a second, Kel, of the capital markets and performance review of the management investment pool, pension fund, and operating fund. And she'll be joined by Tim. Is Tim on the phone as well?
Yes.
All right, so over to the NEPC team. Thanks, Kel.
Great. Thank you, Trustee Martin. And I think I see a new face with John. So John, just by way of introductions, I'm Kelly Regan. I've been working with the University of Maine system since 2007 as one of your investment consultants, and I'm joined by Tim Knightley, who works with me on the account as a senior analyst. So we are your team, and excited to be with all of you today. I listened to Mike's capital market review, and he had a lot of the same things that I wanted to say. So when I go through my review, I'm just going to point out a few things that might be just a little bit different compared to what you heard from Mike. And then I will work into the actual portfolio performance through the end of June, and really focus on your fiscal year to date, and let you all know from a fiscal year performance perspective, all portfolios outperformed the target. And when we look at all the individual manager options, there's no concerns with any of them at this time, and you'll see some nice performance from your managers. So let me start by sharing my screen. And hopefully everyone can see that. Give me a head shake. Yep, great. Thank you, Trish. Okay, so just in terms of markets, I know Mike went through this, but just to reiterate, because we're going to go into your portfolio performance, really strong returns on a year-to-date, and this is calendar year-to-date basis through June for equities. You can see a lot of double-digit results here. If we roll these numbers forward through last Friday, there has been some softening. So we saw a continuation of the first part of the year in July, so good results in July, but August and September have seen some softening in equity results. So for example, the S&P 500 is up about the same through last Friday. The MSCI EAFE is down a little bit from this 11.7 you see here on a calendar year-to-date basis. And then emerging market equities is up a little bit higher than this 4.9%, but still strong overall calendar year-to-date results. In terms of fixed income, we continue to see rising rates. You can see a lot of negative numbers in the quarter-to-date column, really focused on more treasury-based asset classes as treasury rates have risen. On a year-to-date basis, for example, the Barclays aggregate was 2.1% through June. That is now 0.3%. So we have seen some more declines in fixed income given the rising rates. Mike did mention the S&P 500, and one of the drivers of the S&P 500 returns was that I think it was 40% return in the information technology sector. And here is one slide that NEPC put together, which shows the cumulative results of the S&P 500, going up to that 17% year-to-date return through June, and the drivers of those results. And so these dark blue lines represent the top 5 companies in the S&P 500, and the light blue lines represent all remaining 495 companies in the S&P 500. And what you can see is the dark blue lines are much higher than the light blue lines in terms of making up those weekly returns. And that is really driven by companies such as Apple, Amazon, Alphabet, Microsoft, and NVIDIA. And there are some concerns from NEPC on the valuations of these companies and how much these companies are contributing to the S&P 500. And just to know, if we took out Meta, and I'm forgetting the other company off the top of my head, Tesla, out of the light blue numbers and added it to the dark blue numbers, the S&P 500 would have been negative. So very strong results from these top companies, and valuations have been increasing. So there's a little bit of concern there. So if I move on to kind of what that means in terms of being a little bit concerned on the S&P 500, we note here on this page our portfolio positioning views. And so we are counseling clients to kind of reduce their S&P 500 exposure, not through an asset allocation change, but really maybe through a rebalancing change. We have targets to the S&P 500 and a range around that in our investment policy statements. So slightly underweighting the S&P 500 versus our targets. Nothing dramatic, but just taking a little bit off the table. And some of the asset classes that we like to do that and take that money from and put to is US large cap value, high yield bonds, and even global equity, because within global equity, you do get managers that can be very active around US large cap, US or international equities, and emerging equities. And so the one portfolio that we will be recommending this on is within the managed investment pool. There's a 25% allocation to the S&P 500. Today, there is no allocation to the Russell 1000 value, and we're not recommending adding an allocation to the Russell 1000 value. You do have exposure to high yield through some of the fixed income investments, and you do have exposure to global equity. So through the next rebalancing that I work with Tracy on, you'll see that we'll be slightly underweighting the S&P 500 versus. Additionally, given the cash yields, and Mike mentioned this, money market funds are yielding about 5.25% these days. We have no concerns in holding a little bit more cash than targets, specifically for the operating fund, where there's about a 30% allocation to cash. As we work through, the rest of the fall into January, when the next capital inflow comes in, having that additional cash for the time being, we're comfortable with given the yields. So again, it's just having a little bit more safe haven in your portfolio. If we do happen to see a downturn in the economy, which doesn't seem that likely. I mean, we're seeing potential for really high growth numbers coming out for Q3. And so the consumers are doing good. We're seeing some good economic data. So not necessarily, signaling a recession now, but if we were to see some type of pullback, having a little bit more cash will allow the portfolios to take advantage of any opportunities that may present themselves. So I'll stop there and see if there's any questions on our portfolio positioning views and looking ahead for kind of how we would implement these in the portfolios. Okay, Hearing none, I'll move to our performance review and just starting with the operating fund. You can see here in the top left, about 265 million at the end of June. Within the asset allocation, you can see the different allocations to the liquidity pool, which is all cash, the income pool, which is mostly fixed income investments, and the total return pool, which is some equities, but I would say more conservative type of equity investments. And within the ranges, this target asset or this current asset allocation is within ranges. In terms of performance for the fiscal year to date time period, so that's your 1 year number ending June, you can see that the operating fund, the composite, returned 4.2%. That's above the target of 4%, which we try to achieve for this fund. During this time period, you can see a little bit of underperformance versus the allocation index, which is a passive benchmark of how this fund is invested. And part of that is due to some of the more conservative investments in the total return fund, given the strong results that we've seen in equities having a little bit more conservative posture. Those managers did underperform their benchmarks, but this is in line with how we want the operating fund constructed to be a little bit more conservative in nature. And then over the last 3, 5, and 10 years, you can see that the managers in aggregate versus that passive benchmark have outperformed or are in line. In terms of recent actions, we have some manager announcements that I'll go through in a moment after I review the 3 portfolios. And just to note, in the S&P 500 allocation, we were all pure S&P 500 exposure, and we have been moving to the fossil fuel free version of the S&P 500. The 3rd tranche was completed in June, and I just sent a recommendation to complete the 4th and final tranche to the S&P 500 fossil fuel free investment as soon as practicable. I have no recommendations for the portfolio in terms of anything that's been happening in the markets or with the manager performance that we're seeing. Again, there's only about a 5% allocation to the S&P 500 here, so I'm not going to be recommending kind of reducing that exposure given the small weight it exists in the operating fund. I will note, to stay on operating fund for a second here, this year-to-date column of 3.3% is the calendar year-to-date return, so January through June. If I look at this through August, it's about 4%. So we did have some gains in July and then relatively flat in August. So the number on a calendar year-to-date basis is 4%. In terms of the pension fund, this is the smallest portfolio of the 3 that I'll review. It has about 19 million in assets, and it has been declining in asset value given the benefit payments that come out on a monthly basis, which are around 350,000 a month that come out. In terms of asset allocation, we're mostly in line with our targets. There is one caveat for this portfolio. You'll see real assets, which is this 9.4% of this gray bar over here in the top left. That is your real estate manager principal. Through the recent asset allocation study, we reduced this manager down to 3%. However, given the real estate environment, most real estate managers have been putting up queues to get out the withdrawals from funds. So we're seeing this across a number of the managers, kind of just given the higher interest rate environment, given the ability to sell properties and things of that nature, it's been a little bit soft. So we are in a queue to receive our money out. And so for the time being, we are overweight real estate and we are underweight tips. And so right now, tips are falling outside the lower end of the policy band because of this overweight to real estate. And so we'll work our way out of that as soon as we can start to get some money out of the real estate manager. In terms of performance, fiscal year to date, up 6.7%, outperforming the 6.25% target return that we have for this fund. And in terms of manager performance in aggregate, comparing that 6.7 to the 6.4 for the allocation index, you can see some positive manager value add in this portfolio. In terms of recent actions, we did complete some other items from the asset allocation study, which was to terminate the short-term TIPS fund through Vanguard, and then also hire and implement the Treasury product through Fidelity. So that did occur in the month of June. In terms of recommendations, there's no recommendations for the pension fund. There is no dedicated allocation to the S&P 500 in this fund. It's all implemented through a global equity manager called Walter Scott. So thinking back to my portfolio positioning views, there's no rebalancing need to kind of underweight the S&P 500 in this fund. And then in terms of the year-to-date performance of 6.3% through June, it's now about 5.7% if we roll this forward through August. Again, some softening numbers that we've seen in August. And then in terms of the managed investment pool, you can see the assets are about 362 million at the end of June. Within this portfolio, we're very diversified across a number of asset classes. You can see them listed here to the right of the pie chart. And if we look at these within your policy statement, you are within ranges for all asset classes for your policy statement. In terms of fiscal year-to-date performance, this portfolio has the highest allocation to equities, so it has the highest return of all three portfolios of 10.6%, which is outperforming the 7.25% target return that we want for this portfolio. So it was a very solid fiscal year for the managed investment pool. And then in terms of manager performance, a little bit of slight underperformance by about 30 basis points on a fiscal year-to-date basis. Some of that coming from some conservative managers, such as equity long-short managers and a global asset allocation manager. The one thing that we show for this portfolio that's different than the others is down here at the bottom of the right-hand side table, the ranking. So we look at the returns for this portfolio versus peers of other endowments and foundations with similar asset size. So we look at 100 to 500 million, and then we take your return and rank it versus the return of all those peers. And what you can see over the quarter, the calendar year to date, and the fiscal year to date, that you're ranking above 50. So 1 is the best, 100 is the worst. So you're ranking above better than half of that universe over all these time periods. And part of the reason there is we've seen such a strong result from the equity markets. And if we look at your asset allocation versus peers, you tend to invest more in public equity than your peers. Your peers tend to have a higher allocation to private equity. And public equity has been outperforming private equity over these more recent time periods, which has helped the rankings of this portfolio. Longer term, over the 3, 5, and 10 years, you can see the rankings fall below median, and it's just the opposite story there. Over the long term, it's expected that private equity will outperform public equity in the range of 2 to 3%, and that has occurred over the last 3, 5, and 10 years. And not having that private equity allocation has led to some below peer ranking results. In terms of the year-to-date performance of up 8.8%, it's pretty stable. It's up 8.9% through the end of August. So we saw some nice performance in July and some pullback again in August. In terms of recent actions, we did rebalance the third tranche from the S&P 500 to the fossil fuel free version. And I'm in the process of working up a recommendation to complete the fourth tranche, and we'll be sending that to Tracy in the coming weeks. And then also this plan or portfolio did also hire the Fidelity Treasury Bond Strategy, and that was implemented in June per the last asset allocation study that we did. Any questions on overall top level performance before I dive in and show you some individual manager performance?
Yeah, Kelly,
Yes.
the Kellys, I think we talked at the last meeting about it's almost time for the annual report to the board about the divestment strategy. At what point, and I'm sorry, Kelly Martin, I've forgotten the work plan. At what point did we want to do that?
I think it was at the January board meeting. Was
Yeah,
that-
okay. I just want to make sure the investment committee sees it first and we bring it to the board because that'll be of interest to them.
Yeah, Trustee Riley, last time we did a fossil fuel study and looked at the exposure for all three portfolios was with September 30th, 2022 numbers. So my thinking was we'll take it and we'll do September 30th, 2023 numbers. I'll present that to all of you at the December meeting, have a discussion around that, and then we can see where you all want to go in terms of going to the board with that information.
Perfect. Thank you very much.
You're welcome. John, do you have a question?
Yes. Could you give me a definition of a fossil-free divestiture? I understand the concept, but just how far you go with that as far as, okay, if if you're out of fossil fuel, but you're doing heat pumps, which take electricity from power plants that use coal, propane, etc. Is it just primary, or does it go secondary, tertiary, etc.?
We're using what's called the Carbon 200 underground list. And so to answer your question, I would say it's more the primary companies that have the highest, fossil fuel exposure. Does that help answer your question?
Yes, thank you.
Hey, John, Kelly and I can give you, this was a long discussion.
Sure.
So we can give you some of the background offline some other time.
Okay, no problem. Thanks.
Any other questions before I go into manager performance? Okay. Before I do that, let me just mention our due diligence monitor. So we're always monitoring all your managers and come to you if there's been any announcements or changes, and you'll see there's 3 here. The first one was Silchester, which is your international equity manager that is fossil fuel free. They had an announcement, and it's really due to one of their affiliates called Sanderson International Equity was having some struggles with their succession planning for their next generation, and seeing some asset outflows, and it has been determined that they're going to shut down this fund. This has no impact on the parent company, Silchester, at all. It's just a for your information. If you do see in the news Sanderson being tied to Silchester, and you say, oh, I have Silchester in my portfolio, how does this impact me? So it's just a note here. There's no action for the committee to take on this. Within PIMCO All Assets in your operating fund, it is what I'll call a fund of funds. It's a portfolio of underlying PIMCO funds. And within the credit suite of the PIMCO funds, the head of credit is moving over to Europe to start one of the European offices. Again, not a big change, just again, for your information in terms of PIMCO. And then principal real estate, it's no action, but I would say out of these 3, this is the more meaningful one. So the principal real estate fund is managed by 2 co-portfolio managers by the name of Megan and Darren. And Megan is leaving the principal firm after being there for 17 years, and they have replaced her with another co-portfolio manager. So again, no concerns about this, but just wanted you to be aware of that there is a co-portfolio manager change at principal. Moving into the performance, I'm going to focus on this fiscal year to date column here. And what I'll say is across the board, managers are doing quite well. And even in portfolios where one manager may be lagging behind, we have them paired with another manager, and the combination of managers are doing quite well. And I'll show you what I mean by that. But just to start, I'm going to start with the domestic small cap area. You have 2 managers here, Westfield and DFA. Westfield tends to be more growthy, and DFA is more value oriented. You can see both managers are outperforming benchmarks, and both managers have a ranking in the top quartile of their respective peer groups. So for example, Westfield, a small cap growth manager, their returns are being ranked in the small cap growth manager universe. And combined returns of 18.1% in this blue line, above the Russell 2500 index of 13.6%. So the combination of these 2 managers is outperforming the core index as well. Walter Scott is your global equity manager. You can see performance above benchmark and very strong rankings, close to the top decile of other global equity peers. And then within international equity, both J.O. Hambro and Axiom are international managers. J.O. Hambro is more large cap focused, and Axiom's more small cap focused. And you can see both of them are underperforming benchmarks and underperforming peers. Both of these managers have a growth bias to them. And I think you heard from Mike earlier on that in 2022, growth was underperforming. It has since come back. And so if you look at the calendar year-to-date returns, you can see both managers are outperforming their benchmark over the last 6 months and have been starting to rally back, given that growth is back in favor. In terms of emerging market equities, we have Aberdeen, which again is more large cap focused, and Mondrian, which is more small cap focused. You can see Aberdeen's in line with benchmark and Mondrian's outperforming benchmark. In terms of rankings, Mondrian has the better ranking of the two. We ranked these two managers in an emerging market universe. And that emerging market universe does have small cap managers. And you can see by Mondrian's returns, small cap managers have done better. So by nature, Aberdeen being a larger cap manager is going to rank at the bottom of the universe, but we're not concerned with that ranking. Overall, 9.9% for the emerging market equity returns when you combine these managers, ranking in the top third of the universe. So both managers is how we have them paired together, and they've been doing nice versus the broad benchmark. This next page is the fixed income page and the diversifying assets. Starting with fixed income in the fiscal year to date column in this blue line up here, you can see fixed income is up 1.5% on a fiscal year to date period. This is when the Barclays aggregate was down 90 basis points due to those rising rates. We've constructed your fixed income portfolio to have a combination of traditional aggregate exposure, so treasuries, mortgages, and credit, as well as pure treasury exposure more recently. But then we diversify that with things more below investment grades, such as bank loans, or even within BlackRock strategic income opportunities, things such as high yield emerging market debt. And the combination of having those more credit focused assets has led to this portfolio outperforming the broad Barclays aggregate index. In terms of, I had mentioned earlier, some of the MIF underperforming that blended benchmark, what we call the allocation index. Some of that is due to managers such as Newton. You can see a negative 2.5% return, in Lighthouse, a positive 5% return, but certainly below what traditional equities have returned. These two managers are managers in your portfolio that are designed to do well when we have struggling equity markets, and their returns are reflective of the positive equity markets that we've seen in their underperformance. And then within Landmark, this is a private equity position that is rolling off. You can see 0.3% allocation. These returns are a time-weighted basis. We've been receiving some money back from this manager, so you can see some negative returns there. If you look at it on an IRR basis, this manager has about a 12 to 14% IRR over the since inception period. So I focus on that number over the time-weighted results. In terms of the pension fund, a lot of the same managers here that we have in the managed investment pool. The one exception at the bottom of the page is that Principal, your real estate manager. You can see over the shorter term, given the rising rate environment, some of those negative results. They're still receiving income, but the capital appreciation of their properties has been negative. However, over the long term, you can see some nice returns, 8% over the 10 years on an annualized basis. So long-term results still look strong, but they are still seeing some softening over more recent time frame. And again, just a reminder, we're waiting to get some capital back from them. And then for the operating fund, just starting up in the liquidity pool. Again, this is 4 different type of cash investments ranging from the state pool to traditional money market funds. And on the fiscal year to date, you can see some positive returns for these managers, given the Federal Reserve raising rates quite drastically over the past year plus. So we're starting to see some actual return from cash investments. In terms of some different managers in this portfolio, one is the Income Research and Management, which is a very large holding. It's short-term treasuries and credit. Very solid manager that's outperformed their benchmark over all time periods and has ranked around the top third of other short-term bond funds. So that's a different manager that's in this program that is not in the managed investment pool or the pension fund. And then down here at the bottom in our total return composite is PIMCO All Asset. This is a manager that's similar to Newton in that they invest in a lot of diversifying asset classes. I would say they do it differently than Newton, and you can see that by the results. They're up 4.7% on a fiscal year to date basis, outperforming their benchmark. They've outperformed their benchmark over all time periods, and they just kind of do a little bit different than Newton, where they invest in things like commodities and tips and other things that are not in this portfolio to give a little bit more diversification to the operating fund. So I will stop there and see if there's any questions. That was the end of my prepared remarks. Okay, hearing no questions. Overall, hopefully what you heard is on a fiscal year-to-date basis, the portfolios outperformed their objectives from a return perspective. That we do have some managers that are underperforming or outperforming, but generally in aggregate, the results are positive to just, slightly negative for the MIP. And then in terms of manager announcements, there was 3, no actions recommended, and there's no recommendations to change any of the managers that are in any of the 3 portfolios to date. So Trustee Martin, I'll turn it back over to you.
Thank you. Thank you for those, the commentary and the remarks, and thank you for the good work that you and Tim do for our 3 portfolios. And without further ado, I believe we're done. Does anybody have questions on the committee? Hearing none. I keep on forgetting. Do I need to no, I could just adjourn and have you guys go off and enjoy the beautiful day. It's beautiful in Fort Kent. I hope you're enjoying the same weather we are up here. So,
Thanks, Kelly.
all right.
Thank you, everyone.
Enjoy. And I wanted also to thank Tracy Elliott and Ryan Lowe for the good work they do also for the investment committee. So, and the members of the investment committee for your time.